So the main topic on this should be income tax. Income tax, where we need to check both current and deferred tax. The main objective or the main part of this is on the deferred. Current tax is not even a big issue. Just pass there. So deferred tax, from the word defer. Defer means to be carried forward. So deferred tax normally arises in this form. It comes up in so many ways. One, I want you to check how the Kenyan system, so in Kenya, how we operate. Most companies, you will find them closing their financial statements on 31st of December. Then the taxman will come for the audit and filing of returns on or before of the following year. So accountants, when the accountant was closing the financial statements, they close the financial statements for most of the assets and liabilities. They close at net book what? At net book value. Net book value, how do you get net book value? It is the cost of the assets minus the accumulated what? Depreciation. I appreciate all of us must have done tax at one point. For taxation purposes, taxman doesn't know anything called depreciation. Is that true? Yes, taxman will assess, will recognize the assets, not at net book value, but at written down what? Value. For tax purposes, we record the written down value. In which case, the written down value is the cost of that asset minus what we call accumulated capital what? Allowances. Capital allowances are wear and what? Things like wear and tear. So depreciation is always disallowed for tax purposes. So yes, depreciation is disallowed. So you find that if the accountant was to pay tax, they will assess tax on the book value of the asset. But for tax purposes, the same asset, taxman here now represented by the auditor, will assess tax on what we call written down value. So definitely, you will find that there is variation. So that variation, it can be a refund or it can be payable. So according to the accountant on the assessment, they got tax on the net book value, based on net book value to be 200. Here, they determine 300. It means these people are underpaid and we have tax to pay in the future. So a prudent accountant, what they will do, based on the past experience, they will make a provision that when we assess tax based on this, there will be another tax which will come due to the variation in the taxable profits and even the written down values. Then they make provision in the books in December and they call it provision for deferred what? Tax. That might arise in future because when you check out, people pay the installment in each other before audit. So to avoid profit overstatement, we the accountants, we just make a provision to cater for those future taxes which will arise due to variation in the disallowable and the allowable what? Expenses. So that is how deferred taxes normally arises. So let's write and say, I'm going to be very brief on the write-up. You say deferred taxes and future tax obligations. Deferred taxes and future tax obligations. And future tax obligations. Full stop. Another hyphen. IS 12 requires that deferred taxes IS 12 requires that deferred taxes should be computed. Deferred taxes should be computed from temporary. Should be computed from temporary differences. Should be computed from temporary differences. Full stop. So down there, that one means, therefore means that deferred tax, it means that deferred tax is equals to temporary differences. It is temporary differences times the tax rates. Temporary differences times the tax rates. That is how you calculate. We'll be calculating deferred tax. So the question coming up should be, what are temporary differences? So write down there, temporary differences. Temporary differences. Temporary differences. Then you say, is the difference between the carrying amount, is the difference between the carrying amount, between the carrying amount of an asset, the difference between the carrying amount of an asset or liability, carrying amount of an asset or liability, and its tax base. And its tax what? Tax base. That is how you calculate that is the definition of temporary differences. So down there, from that definition, therefore means that deferred tax, therefore means that temporary differences is equals to carrying amount minus what? Minus the tax base. From that definition, that is the temporary differences. It is the difference between the carrying amount of an asset or liability and its tax base. So the next question will be, what is carrying amount and what is tax base? So down there, you say carrying amount. We cannot just waste time like that. Time is. We must be very smart. Carrying amount is the difference between the cost of an asset and its what? Accumulated depreciation. Then tax base, you will consider the cost of the asset minus accumulated. Let me just say accumulated where and what? There, for capital allowance. In which case, this is the LBV. This one is the WBV, the written down value. That is the written down value. So when you check it keenly, it is the difference between the accountant and the tax person. Accounts comes first. So for tax purposes, the auditor will, the audit report is what we are going to file. So the auditor will concentrate on the capital allowances, wear and tear. Accountant will be checking depreciation. So depreciation, when you allow people to subtract depreciation for tax purposes, nobody will ever pay tax. Is that true? Yes. If depreciation can be allowed. Okay. Once we estimate that next year we are going to pay tax of 8 million, what will people do? The tax is 30%. I take 8 million divided by 0.3. That's how much? 8 divided by 0.3 is coming to 26. Where 26? Yes, so I will buy an asset worth 26 million. Then after the 26 fail. No, you know the tax payable is 8 million. We have estimated. And I want to reduce that tax to 0. So I will buy an asset of 8 million. Yes, of 8 million. Then I say that this asset is depreciating per annum at the rate of 100. Depreciation rate is 100% per annum. Nobody will question you. Depreciation is a management policy. There is no regulation that you should depreciate at what rate. Nobody regulates. Only where it is regulated by the class of the asset. So you just say whichever rate you are. So I will just come and say my asset has depreciated with 8 million. So if taxable is 8, I also expense 8 and the story ends. And that is why taxman cannot allow you to subtract what? Depreciation, it will be abused. All right, so deferred taxes will be based on temporary. Temporary will be based on the difference on what the accountant has assessed and what the taxman has assessed. That difference, it will bring tax variation, but now in future, because this one comes earlier than the amount which will be assessed for tax purposes. So once you get the temporary, you subject the temporary to tax rate, and that is the deferred what? Tax. Down there, types of temporary differences. Types of temporary differences. Types of temporary differences. We do have 2 types of temporary differences. There are 2. Number 1, taxable. Taxable temporary differences. Taxable temporary differences. Taxable temporary differences. And 2, deductible. Deductible temporary differences. Deductible temporary differences. Allow me to start with the taxable. Taxable temporary differences. Taxable temporary differences. In bracket, they're also known as positive. Positive temporary differences. Positive temporary differences. Taxable are also known as positive. So you say, these are temporary differences. And by then you are filing returns. People are filing returns. There's something which I've realized, KRA on Fanya. I don't know whether you have noticed. You know, there before, you could just, once you insert the auditor's PIN in the limited and you capture the details, you just validate and submit. But I don't know whether you have realized, they have insisted the auditor must be a KRA tax agent. I don't know whether you have noticed. If you capture that PIN without the auditor being KRA tax agent, you cannot even submit. You have noticed. Even last year I never experienced. I saw it this year. So that person must be a certified KRA tax agent. And I know why that thing is coming up. There is a serious conflict online. Let's proceed. Let's proceed. This video can be viewed by many. Yeah? So let's start with taxable temporary differences. Maybe what I wanted to pass across, if you get yourself in that situation, don't hesitate to call me. I'm a KRA tax agent. I can just give you my PIN and you validate. Remember your story. So taxable, you say, but when you are filed properly. These are temporary differences. These are temporary differences which arises. These are temporary differences which arises when the carrying amount. These are temporary differences which arises when the carrying amount of an asset stroke liability is greater than its tax base. is greater than its tax base. Full stop. Another FM. They give rise to deferred tax liabilities. They give rise to deferred tax liabilities. They give rise to deferred tax liabilities. Full stop. But I think still, because this is our profession, we can still check across. There is something which even me, I don't understand well, and which I think is what KRA is doing. When you are doing auditing, they say in auditing that the primary responsibility of the auditor is to examine the financial statement and to express what? An opinion on whether the financial statements reflect true and fair view and whether they have been prepared in accordance with the International Financial Reporting Standard. Full stop. So the taxation and the rest, those are considered to be other what? So these are the secondary duties of other services which the auditor may provide. Yeah. So the argument here is, why must we consider the auditor for filing tax purposes? Hence, in audit profession, we are told that filing of taxation is a secondary what? Duty. So KRA, like they are trying to be associated. Is part you do the audit and to make your books put a foot and loan, but the person who should file should be a tax what? Agent. And I'm seeing in the near future, these restrictions are coming slowly. It will be like right now, the PIN mark which must be there. Okay, auditor can also be a tax agent. You must be a tax agent. And in the future, they will restrict. You know, government is funny. They will say, for you to be a tax agent, you must be trained by KRA, meaning you must go to Kessler. You will come to see that pass. So, you are your restriction. So the taxation and audit, they are trying to separate the two. Even ISPAC, they have already separated the certificates. You know, certificates has been on audit only. Right now, there are 3 of them. You can be audit, tax, and the management part. So they have separated the certifications. Let's go to number 2, deductible temporary differences. Deductible temporary differences, which is negative, in bracket negative. Negative temporary differences. Negative temporary differences. You say, arises when the carrying amount of an asset stroke liability arises when the carrying amount of an asset stroke liability is less than its tax base. It's less than its tax base. Full stop. Another item, they give rise to deferred tax assets. They give rise to deferred tax assets. Full stop. So if you get negative, this one here, when the carrying amount is more than the tax base, of course, that is positive. Positive, that's a liability. You have to pay. If this one is less than tax base, that is negative, that is what? A refund, which is deferred tax asset. It's like a story, Mingi. Let's do, provided we can do as many questions in that paper, that is the most important thing. So let's start with 2017. So get out your paper. I have a target of doing at least 4. At least 4. When you do 4, at least, yes, at least 4, at most 5. Then I can consider that done. The good thing, they are just more or less the same. So 2017, which 2017? And which page? May 2017. May 2017. Who is there? For those things, May 2017, question 4. Question 4, there I am. I got it. My page, it is page 8990, somewhere there. Four. 4B, eh? 4B. 4B. Four B. So May 2017. So 4B. There we go. So I read. How do you redact them? Limited, a manufacturing company, provides for deferred income tax in accordance with IS number 12, income taxes. The following is an extract from the statement of financial position as at 30th April 2017. So balance sheet as usual, you can see it there. Additional information number 1, the tax basis of the assets are as follows. So we have been given the tax base of PPE, prepayments, interest-bearing loans, financial assets available for sale. So what you need to know without being said or without you being told by the examiner, the values which appears in the balance sheet are always considered to be the carrying amount unless otherwise stated. So these are the book values. So the ones in the balance sheet are the carrying what? Amounts. Now, then, number 2, inventories are stated at fair value less cost to sell, which is lower than the original cost due to a general provision for decline of 3.5 million. The intangible assets comprise development cost, which is tax deductible when the amount is paid out. The cost of intangible assets was paid in the year 2014 and is presented net of amortization costs. Goodwill and employee benefits are tax what? Exempt. When they are tax exempt, that one means they don't have tax base. Any moment you have tax base, then it means it must be assessed for tax purposes. So regardless of whether, because even it's common sense to us, if people start taxing goodwill, will you declare goodwill in your books? Can people declare goodwill if goodwill will be taxed? You will tell people I'm suffering. Biashara iko mbaya, senior. Yes, so goodwill is always tax exempt, meaning even if it has a book value, even if the examiner gives you the book value, tax base will be 0 and temporary, because the difference between carrying amount and the tax base gives you temporary. So temporary will be 0 regardless of the book what? The book value. That is the name. Trade and other payables include provision for leave allowance of 1.4 million, which is tax deductible on cash basis. Trade receivables are stated net of general allowance, for bad debts at the rate of 5% of the gross receivables. Fine. The general allowance is not deductible until it becomes what? Specific. The building, which is included in the PP, was revalued during the year. The increase in value of 3 million does not affect the tax base. The tax base of other items is equal to their carrying amounts. The tax rate applicable is 30% required. Deferred tax balance as at 30th April 2017. Then deferred income tax account, 14 months. Fine. So right there, you said it is Munro. So right there. Deferred tax computation. As at when? You're saying as at 30th April 2017. Once we do the first one, chelewa hii maisha itakuwa rahisi. Itakuwa sawa. So how do we calculate deferred tax? Deferred tax we calculate from temporary differences. How do we get temporary differences? You take the carrying amount minus tax base. So what you do, you write here assets and liability or stock liabilities. So allow my assets and liabilities there. Then have the carrying amount. Carrying amount. Then you will have your tax base. And the difference between the two, between the book value and the written down value, will give us what? Temporary differences. So that once we have our total temporary here, we just subject the temporary tax rate, and that is deferred what? Tax. 99% of accountants, even those who are seated here, they don't give provision for deferred tax. Reason, they don't want. It's very easy because there's nothing. Because carrying amounts to depreciation rate uko nayo. Ile unatumia, sio? Na tax base, what you need is the wear and tear. And wear and tear, you can just know the class of the assets. So assets are which, how many classes? Are they 4? Yes, there are 4. So you just check the rates. Then you get it there and you get the difference. Then you give provision. So shillings are in thousands. Shillings are in thousands. Or something like that. So we start. So go to the balance sheet, those items. So rule 1, the balances appearing in the balance sheet, those are the carrying amounts unless they have said anything. So current assets, are you seeing the PP? Yes. So property, land and equipment. For you to be given the carrying amount, all adjustments have been made, including those revaluation and the rest. So carrying amount here is how much? It has been recorded at 14. Tax base. Were we given the tax base of the carrying amount of the PPE? Not one. Yes, we were given PPE a tax base of how much? 28. So temporary. You know, accountant ni anatangulia. Nani anaanza na books? The accountant ama auditor? Si ni accountant. The auditor ende ajitoe. Asema it was the responsibility of who? The accountant. Sema kizungu serious. It was the responsibility of the management. To prepare the financial statements. Ajitoe ndio asipatikane. So the difference comes to how much? 11,200. I can write but not a must. This is called TTD. TTD stands for taxable temporary differences. And this one will lead to deferred tax liability. Positive is tax. Let us be positive. So this is a liability. This is taxable temporary differences. Next, intangible assets. Intangible assets. What is the book value there? 4. Were we given tax base or we go for the notes? Tax base we were not given in note 1, so there must be additional information. Though Najuanga in about 0, all intangible assets are 0, but let's read so that you can see how it comes. Which note? Note number 3. Check additional information number 3. The intangible assets comprises development costs, which is tax deductible when the amount is paid out. So when they pay, it becomes deductible, which means it's allowed for tax purposes. The cost of intangible asset was paid in 2014. This is which year? 2017. The examiner is telling you, when the cost has been paid, then that amount becomes tax deductible. It means it is allowed for tax purposes. And the amount was paid in 2014. So when was it tax allowed? So in 2014. Yes, and it's presented net of amortization. It means when you want to check the tax base, there is no amount you are assessing for tax purposes because the whole amount has already been done what? Allowed for tax. So the tax base is 0. But this one will still be subjected to further tax assessment. So when they say it is tax deductible when paid, it means when the amount is paid, the whole amount becomes allowed for tax purposes. That is the meaning. Next item, after intangible, goodwill. So there is goodwill. Goodwill, don't even wait for them to tell you. This is 6, but they say, check note number 4. Check note 4. Check note 4. Goodwill and employee benefits are tax what? Exempt. Tax exempt means we don't assess that item for tax purposes. So even temporary will not be there. Regardless of the book value, anything which is captured here will be assessed for tax purposes. So nothing, even employee will do the same. Financial assets. Financial assets. What has happened today? Oh, umelala. It's good to say the truth. Ama ulala leo. Maisha, sometimes it comes like that. Don't worry. God knows why you are late. No. Maybe sometimes so God will just want you to come when for things which are serious. So financial assets, the book value is 12. Take it keenly, they can examine. But this is our question 1. We want to do 4. So just okay. So that is 12. Were we given tax base? Yes, we were given tax base to be how much? 14. So the difference is 2, but negative. Negative is called what? Deductible temporary differences. Good. Inventories. 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 75. Where did they talk of inventories? Which note?
Note 2.
Note 2. So check note 2. Inventories are stated at fair value, less cost to sell, which is lower than the original cost due to a general provision for price decline of 3.5. So this amount is net of the price decline of 3.5. But taxman here at Ikuja, the question is very simple. What was the cost? Because tax base will be the cost minus the capital what? The capital allowance. So where the capital allowance is not there, then the tax base is equivalent to what? The cost. Because people can understand, they just say there was a price decline, then they understand for their own benefit. So they are saying the amount is stated net of price decline of 3.5. So for tax purposes, gross back first. So gross it back by adding back the 3.5, it comes to 11. So when it comes to 11, now taxman starts from there. The cost is 11, yes. How much was the capital allowance? There was no capital allowance which was given. So it means for tax purposes, the tax base will be how much? 11. Taxman will gross back. They will not allow you to say, oh. So it means taxable is what? At what? At 5, which is sensible. Any tax effect on stock should be deductible because stock is tax on sales. So, yeah, so should there be tax effect, it should always be deductible. Next, receivables. Well, okay, the tax from January to then what will guide you from there? Receivables 6650. Note number. Which note? Note 6. Check note 6. Check note 6. Receivables are stated net of general allowance for bad debts at the rate of 5% of the gross receivables. The general allowance is not tax deductible. So it was not supposed to be subtracted. So the taxman comes first, gross back. So it means this 6650 is at what percentage? 95. No. Yes. So can you get me 100%? Because they have deducted 5% for bad debts. So this is at 95. Get 100%. And now that there is no capital allowance in regards to receivable, that 100% is the tax base. 7,000. So this was 7,000. So it means temporary will be 350. Well, that is deductible. Imagine you allow even tax. Ukivuta hapo secretary nilisikia watu wa tax wakiambiwa bad debts you lazima kuwa specific. Kulikuwa na kitu kama hivi. It must be specific. I don't know that specific, but for tax here, you go back to the original cost, then you check capital allowance. Your story here, price decline, bad debts, no. We only allow the capital allowances. Next item is the balance sheet. Tunakwambia tuko balance sheet. So the next item is cash and cash equivalents. Cash and cash equivalents. This is 12 what? 1250. Is there any note where cash and cash equivalent was mentioned? Just cross check. Is there any note? No.
No.
So if there is no note on that, you go to note number 8. Numerical prepayments. So I'll bring them. So naona hata Eli amesema fine. Go to note 8. If there is no note touching on item, then you go to note 8. Note 8 says the tax base of other items is equal to their carrying what? Amount. So anything hawajaongelelea, then the tax base is the same as the carrying amount. So prepayments, prepayments, the book value is 32. Were we given its tax base?
Yes.
We're given not 1, eh? Yeah, not 1, we were given 15. So the difference between the accountant and the taxman there is coming to how much? 1,700. And because now we are in tax, we must talk tax. Are you ready for the teams? Are you ready for the teams? Are you ready for the teams? Not teams university. Team system. Eh? Ama mjui hiyo teams ni gani? Jacqueline anasema she's ready. Mwenye amekubali hapo nyuma. Can you tell us? Because umekataa. You are not ready. So tell us, what is this you are not ready about? So in 1st August. Inaanza 1st August. According to KRA, yes. So ile siku mnaanza mtihani. New system inaanza. So mkirudi job after hiyo mtihani. So tell us much about teams. Achakuna kuibiana. Achakuna kuibia tena. No, what is teams? Sasa nikuuliza what is teams, then unaambia chance sana kuiba tena. Si unamshtua. Charles here, I love teams nene.
It's a new introduction and that to the tax system.
Yes. Yes, so Moiruki is telling us it is an automated ETR generating system. Neo, I know you know, but how could you highlight your teams? So there is new ETR which is coming. Eh? Yes. Whereby when you capture the output cells, it integrates with the iTax. So if you capture in that machine, iTax is updated. So the other person, right now you have realized when you are filing for those people who are on employment, you don't need P9 anymore.
Yes.
So, yeah. Do you need P9? P9. We don't need P9 because you just go to ITR, the employment. Yes. It populates auto. So none of your employment in a kuja automatically. Yes. So VAT will be doing the same. So what walikuzia, instead of capturing those things, unaweka CSV, una upload, itakuwa hapo. So wewe tu ni kuangalia. Na wewe si pia ulifanya transactions. So kila kitu itakuwa input and the output. So wewe yako tu ni kwenda, una capture withholding na una upload. So that new system is coming on 1st August. Joyce, tax invoice management system, yes. So things are going to be very difficult. So yeah, amesema why it is difficult? Hakuna kufanya.
Some of them are going to be represented to jungle without.
It would be impossible. Credit notes. So you pass them on real time. Yes.
Okay, but okay, sometimes, for example, there are some of the, let's say, the suppliers or creditors, which they don't send them on time. You see, like when they say, I can pass them on a real-time basis, but on their side, sometimes they don't effect it on time.
Oh, okay, so now they will have to effect them on time. They were lazy. They are the people who called for this thing. They made the carrier to think outside the box. So now they will be made to capture them all the time. So equilibrium and again. Yeah, so it's going to be very difficult. There's a mess which is coming up here. Because I know it will be chaotic. Because when you see a kumbe huko weka, nikienda to claim hakuna. So my VAT better do I need the inputs to reduce. Wenye wale niuzia hawako weka on real time. Ni date 19, leo 19. Kesho unampigia hayuko.
Okay, but you know what's
Imepeanwa hiyo extension imepeanwa sana. Check. Si kuna hii recorded the classes na watumiana kwa YouTube. Yeah. In that YouTube channel I've talked about that new system. Kwani muangaliangi? Go through it properly. Extension imekuwa mpaka wamechoka na extension. So mkimaliza mtihani, those who are doing the office doing VAT ama kesho enda kwa ofisi kama wewe si mtu wa huko kwa tax department, waulize are you ready for yes. Are you ready for? Yes. So be ready for that. So tunasonga mbele na ukitaji hiyo system pia unaweza niambia. Roughly the system goes for around 55,000 or thereabout. But those with the old ETRs you can still upgrade, but you can only upgrade the mercury. Kuna zingine mzee kabisa. To upgrade will cost you, mtu asikucharge more than 30,000 to upgrade. Let's proceed. Let's proceed in the balance sheet mpaka tumalize. So equity, tax is not assessed on equity. Tax is not assessed on equity. If you try to tax capital, you utasikia story. Ati mimi biashara nilianza tu kuangalia, nilikuwa napita tu mahali, sikukuwa na capital, ndio? Nilianza na picha. So equity will never be taxed. Ignore. Go to the current liabilities. Interest bearing loans. So we have interest bearing loans. Interest bearing loans. So interest bearing loans, how much is this? 16. Remember, these are now liabilities. Liabilities you subtract. You don't add them together with the assets. Then were we given the tax base? Yes. Yes, not one. Interest bearing loans, tax base is 17. So temporary will be the difference, which is how much? 1 positive. Minus 16 minus 17 will be positive 1. Then we have deferred income tax. You don't assess tax on tax. Actually, that is now deferred tax at the beginning. So ignore that one. Trade and other payables. Where are the payables? Payables, 8,000. Also, you subtract. There was a note. Note number 5. Trade and other payables include provision. So this 8 includes provision for leave allowance of 1.4 million, which is tax deductible on cash basis. Cash basis means it is tax when paid. Tax when paid. So inside the 8, there is 1.4, but the 1.4 is only assessed for tax when the amount has been done what? Paid. So to get the tax base, which will be assessed, just take 8 minus the 1.4, because they have not said whether it has been paid. So net out the 1.4. That one comes to 60. 66. Okay. Then that 1.4 will be tax deductible. We don't tax it until it is paid. Next, after payables, we have employee benefits. Employee benefits. Employee benefits, we have 2. But employee benefits was mentioned in note 4. was mentioned in note 4, that goodwill and employee benefits are tax what? Exempt. When they are tax exempt, even the temporary is not there. You're not, anything we make up for temporary will be subject to a tax assessment. So tax exempt, ignore. Current income tax, we don't assess tax on tax. So that is all. So what we want is the total temporary. So can you come up with the total temporary differences? So total, what's the total? 10,650. So that 10,650 is the total variations between the accountant, what the accountant did and what the taxman did. This 10,650 will lead to tax effect. But now because the books are normally closed at carrying amount way before even the taxman arrives, you give provision in the books for deferred tax. So you come here and say, therefore, so we are answering the Roman A, deferred tax, and you have to say whether it is deferred tax liability or asset. This one is going to lead to deferred tax. Deferred tax liability. Positive is a liability. So deferred tax liability. Deferred tax liability. You take the tax rate. Tax rate they said was 30. So 30 of 10,650. Happy? And they will not mark the final answer. Everything you have been posting here will be marked, but most of what they will mark is the temporary differences. So that one comes to 31, 5. Go to Roman 2 of the question. Roman 2, they want deferred income tax account. Deferred income tax account. So deferred income tax, deferred income tax account. Deferred income tax account. So if you are told to come up with the deferred income tax, this is what you do. So shillings are in thousands. So balance brought down when we started the year. Remember, this is 2017. So how much was the deferred tax in 2016? We were given somewhere. Are you seeing under non-current liabilities? Are you seeing deferred income tax 2016? Yes, so that was the opening, which is a liability. So you bring it this side. So balance brought down from 2016. They said how much? 12. Then in 2017, the closing liability, the one which we have calculated, we have gotten, so balance carried down of how much? 31.95. So there is an issue here, which I want us to iron out from this question. It will be most of the questions. When we started the year, deferred tax not paid was 12. When we are closing, 95. So we know increase in provision, because all these are provisions, increase in provision should be expense in the what? P&L, yes. So the balancing figure here should be P&L. However, there is an issue. There is an issue in note number, just a minute, in note number 7. There is an issue in note number 7, which inaharibu hiyo maneno. Otherwise, tungeweka hiyo, the balancing figure you could have captured in the profit stock loss account straight without problem. But note 7 says the buildings which is included in the PPE was revalued during the year. The increase in value of 3 million does not affect the tax what? The tax base, which is okay. Tax man hata kuja kusumbuka na hizo revaluation. So what they are saying, inside this 14, there is a revaluation of how much? 3. But 3, tax man hata was kusema. Tax man hata kujua mambo ya revaluation because hizo vitu zinakuwa sio nataka kujua hiyo story. So here another cost. What was the cost? How much did we allow? So here there is 3. It has no impact here, but that 3 is captured in the temporary. So it means temporary has increased proportionately with the 3, and that one has been carried down to the aggregate here, and it has been done what? Taxed, which is okay. So it means in the 3195 there is tax on revaluation. 3 is there. It was taxed at the rate of that, and it's part of this one. So any moment you are saying to P&L, you get the difference. It means you are going to recognize revaluation, the tax on revaluation in the profit account. And you can appreciate revaluation is an equity component. A profit account. It is part of other comprehensive. So you have to subtract. You have to deduct to get what goes to the profit account. Subtract the tax on revaluation, which is appeared in here, because revaluation is an equity component, which is a balance sheet item. You should not go to P&L. So when you balance here to the profit account, it means you are even taking revaluation in the P&L. So subtract the tax on revaluation, which is part of this 3195, by checking it just 3 times that 30%. So, but how do you subtract? You subtract by crediting the deferred tax account. So you say revaluation, it was 3, but the 3 at 30%, it gave us how much? 900. So it means inside the 3195, there is 900, which was as a result of revaluation. You deduct. So I'm crediting to subtract it from 3195 so that I avoid taking revaluation elements in the profit account. Therefore, the increase is now what I'll take to the profit stock loss account. That is your balancing figure. How much is that? Now 12 plus that minus the increase. That concept. Yeah, it will be in most questions, they like bringing the element of evaluation. So you just get it out to avoid taking it to profit account. This one comes to 1095. So as per the examiner, we are done. But there's a question wanapenda sana. Wanapenda kwa deferred tax hawajaleta. I want you to add manually Roman 3 journal entries. So right there in the paper, Roman 3 journal entries to record the changes in deferred tax. That one they can ask you anytime. Journal entries to record the changes in deferred tax. So if they tell you, when you come across something like that, allow me to do it up there. So deferred tax account. Sorry. Journal entries. So if they require you to pass the journals, then this is what you will be doing. Any moment you have journals, you are simply being asked which accounts to credit and which one to debit. That is how you arrange your journals. So to record the changes, when they tell you to give journals to record the changes, changes means how did it come from 12 to 3195. So the changes which you effect in the journal are these two, this one and this one here. Those are the changes, which is very simple. You have credited deferred tax with what? Revaluation. So which is the corresponding account to be debited? It's the revaluation. So you come and debit revaluation account, debit revaluation reserve account with 900. Then you credit, we have credited already the deferred tax account also with 900 to record deferred tax on what? On revaluation. That is one. Then two, the 1095, we have credited deferred tax in relation to profit account. So debit P&L, profit stock loss account with the 1095 because you have credited the deferred tax. The deferred tax account also with the 1095. Record deferred tax on record deferred tax for the period. That is the deferred tax for this year. Also. So that is just in case they tell you to give the journals. Correct. Alice is asking, what about the current income tax? So current income tax, as far as the question is concerned, if you check Roman 2, the examiner was quite specific on the deferred income tax. So the current income tax will only be relevant for me if I was to prepare, if I were to prepare the P&L extract. You are told to prepare P&L extract, then I will come and say expenses, because we are not seeing income, expenses, and one of the expenses will be the current income tax, and the deferred tax which you capture in the P&L will be 1095. So Alice, yes, it's an expense, and it is allowable for tax. Of course, definitely, yes, yes. It's allowable. How can you tax again? So let's march to the next question here. We go to 2019. We go to 2019. This deferred tax in the P&L. Tax allowable. Lakini ile siku utapata uliweka over, ulikapsha mingi. Utajua we will have to reverse. So you don't just make big provision in the name of understating tax, no? You just make that provision to the extent, that is in accounting profit. Only accounting profit you are allowed. For tax purposes, no. The taxman will come to assess, then they will disallow if the assessment gives us different figures. (2019) November. November 2019. Which question? Yeah, nimeipata. Question 5B. Yeah, question 5B. So check November 2019, question 5B. November 2019, question 5B. The learning curve now, I know it's okay. So we'll increase the speed. You now know what is happening. I know some of you might lie to me, but the truth is, ukifika kwa mtihani umeona swali, mtu unasomanga swali ama unasomanga require? Si unasomanga require? Yes. So inakwanga hivi, unaangalia require, then you check the name of that company. So can you read the require? Wacha na swali. Soma require. Relevant? Temporary. Now we know already temporary is carrying amount minus what? That's soma the name of the company, right? What? Temporary differences computation as at that presentation. So that as we read, we post. So, hakuna haja tusome hiyo kitu yote, then we come back. It is not useful. But life sometimes is very fun, yeah? Imagine the way you are doing very serious things here. Then, at the workplace, you find that the boss, and I know it happens, the boss considered what was sales and marketing to be more better than accountants. It's true. Now, to say wanafunzi watu wakikutana na mtu, unafanya nini? Unamsalimia. Then, after kumsalimia, tell that person what any other human being wants to know. Those who are doing auditing, you must have come across what is called window dressing. Fraud. What is window dressing? Huh? Window dressing, Nini? Yes, the way he's saying, making the financial statements look presentable. You give the picture you are giving is not the truth. Yes. For example, there's something which happens. I know some of us came from high school long time ago. Then ile siku una feel, unajua as human being, kuna siku una feel sijavaa vizuri. Hiyo siku ni unakutana na mtu wa high school mwenye mjapatana for the last 15 years. Na ile siku ulivaa vizuri ampatani. Then anakuambia unakaa vizuri, sio? So, I don't know why employers, they normally consider people in the sales to be, in fact, I don't know whether someone can attest, in most companies, they pay sales people more than accountants. And when you check the education, accountants struggle much than those people. Again, kila gani, hii kitu hapa inaitwa institute. There is back. They are not serious. And the form is back here. Revolution. Upon a revolution, you know what happens? You can only talk of that when you are out. We will get to vote in. You join them. Forget about us. And life goes on. And don't always think that is the nature of human beings. You work for you and yourself. Watch out and give the money you work with you. And that is where you. This part should be serious to get that. But now how? It is difficult. You scare one of the sales people arguing. They were saying that when we were being taught commerce, the definition of commerce. Do you know the definition of commerce? They said commerce is the trade and the aid to trade. So they argue that they are the trade. Then accountants are the aid to trade. Zile vitu zinasukuma, unajua aid to trade zinasukuma hapo nyuma. Lakini trade iko hapo mbele. So they argue they are the trade. And it's also a talent. You know, being a salesperson is not easy. The way I look at some of you here, when you know the God, wanakasirika haraka. Sales ndani mtu anakasirika. They cannot be there. Kwa angalia ni kwa wako wani kawe mtu anaweza. Huyo hapana. I've done that because of my space. Carrying amount tax-based temporal differences. You can write in full. So what are the petition macho? Millions. Shillings are millions. Shillings are millions. So we kick off. Yeah. Is that when? 30th September. Yes. Okay. Thank you. Let's kick off. So as we read, we post. So tunasoma hiyo kwanza, tunaangalia carrying amount tax base tukisonga. So number 1, there we go. The company has available for sale financial assets. Thinking begins after you have written that. Whatever you get, you collect very fast. Financial what? Financial assets. With a carrying amount, the company has available for sale financial assets. So this is available for sale, so no problem. With a carrying amount of how much? 80 million. What you have been given, you capture. The carrying amount is 80. And the financial asset at fair value through profit and loss of 40 million. There's another one. So this one was supposed to be AFS, available for sale. Available for sale, financial assets. Then there is financial assets. Financial assets at fair what? There are 2 of them at fair value with the carrying amount of how much? 40. There was available for sale financial assets and financial assets at fair value. The first one, they are always long term. These ones are short term. So, continue reading. Both financial assets had reported, had means these values are already, they have subtracted. Yes, had reported losses in their fair value of 8 million each as of 30th September 2019. So auditor is coming for audit. These are the book values. But the book values, they had been recorded net of the loss in value. Taxman will not allow you to subtract those losses. Gross back, we check whether there is capital what? Allowance, which is not there. So taxman will not have a lot of story with you, but to gross back those losses which you are capturing there. Then now that you don't have tax base, you don't have capital allowance, then the tax base will be will be the initial cost. So this is 8, this is 8. Tuko salama? Yes. Let's go to number 2. Let's go to number 2. Inventory. Thinking begins after writing inventory. At least maybe I want to object and make up your bills. Anything you capture, you don't waste time. Inventory is shown at the lower of cost and the net realizable value. The cost is 32, while the net realizable value is 31.20. So one is carrying amount, the other one will be tax based. So which is which? 31.20 is carrying amount. Yes. So 31.20, the net realizable, that will be the carrying amount. While taxman will assess tax on costs, on the initial cost, which is how much? 32. So a variation of 80. Also negative, right? Sure. Let's go to number 3. Here number 3 I'm not even reading. Chapter number 3 mpaka mwisho. I can see people collecting what they can see very fast, which is a good spirit we want. So number 3. Calculator. Nimewapea because najua receivable hiyo kizungu umetumia kwa natumia in almost all the questions for deferred tax, and people do get different answers. So I want us to get that story from the word go. Sema answer yenye umepata. So receivable carrying amount is 2,000. Ukipewa you don't overthink. Tax base. Ati hakuna? Sema tu yenye uko nayo. Ili nasema tax base is temporary difference is 240. No, nataka tax base. 1920. 2240. Wewe sema tu yenye uko nayo. 2240, 1920, 1760. 1760. 0. Of all those answers, able to send tena? 1920 was the first one. 1760. 2240. 0. One of those answers is correct. One of them is correct. And the one which is correct is 1920. Yes. 1920 is the correct one. Angalia tena kidogo. The question is very clear. Yes. $1920 is the correct one. Are you in a position to explain? So we start with 2, then we add back. We add 80. We disallow the 80. Then where you are getting the problem is on the foreign exchange. The foreign exchange gain of 160. Some people, I think you are adding. You're adding the amount. No, you cannot add because they have said it's in the gain. So gain had been used to do what? You know, the allowance in code that is an expense. So add back. But this is what? Foreign exchange gain. So you net off. And actually they've said unrealized. So you reduce, you don't add. Unless, if it was an expense, fine. Foreign exchange loss, I would have done what? Added back. Melewa? Yes. Foreign exchange, it includes foreign exchange what? Gain. What does that mean? The gain is already included because if it was a loss, that is when we assume it had been done what? Subtracted. Tunapatana? Yeah. You know this again. The gain, the 2 is gain inclusive, which for the book value there is no problem. But for tax purposes, that gain is not supposed to be there because actually we should tax when we do what? When we realize. So subtract, we subtract. But if it was a loss, then the loss we do what? We add back because they will have subtracted. So you take 2, it is 2 plus 80 minus, the gain is here, minus how much? 60. That is how you get 1920. So 2000 minus the answer, positive 80. Sawa. Songa mbele. Number 4, trade and other payables. I will just write payables. So payables are stated at 36 after making a provision for discount of 40. Please, chapa hiyo mpaka mwisho. So the carrying amount, 600, we subtract. Then we gross back the discount. Ama kiari watakuwa tukipewa watu discount hiyo ni inakuwa lao. Tajua hata hapa tutapea kila mtu discount. So no, usiati tunapea discount inaandikwa huko lakini in reality hakuna discount. So add back 3640. So this one comes to 40 negative or positive? Positive, yes. Minus, yes. That is positive. Then number 5, PPE. Staki kusoma. I don't want to read. Can you read and attempt across? Read and attempt across. So PPE has a carrying amount of how much? 4,800. And at kwani imekuwa nyepesi hivyo? Bado unaweza ona ni kama unakosea. Because some land and buildings were revalued upwards by 200 during the year. What you need to appreciate, once you've been given the carrying amount, that revaluation iko hapo ndani. Your revaluation ni ile inaenda kutusumbua huko kwa deferred tax account. If for you to add revaluation, they must have said the PPE at the cost of this. So if that's the cost is when you add revaluation to get the book what? Book value. And furthermore, some land were revalued upwards by 2 during. These figures we are capturing, are they during at the end of the year? At the end of the year. So it means the valuation which took place during had already been adjusted. Yes. So don't add revaluation there. That is why we are here. Number 6, intangible assets. Intangible assets. Intangible assets consists of trade licenses being amortized over 5 years. Had a carrying amount of 240. And before we saw me, intangible assets na tax base is 0. But let's continue reading. This was allowed for tax purposes in full. How many years ago? 2 years. So the issue will be, what was the cost? 240. How much was the capital allowance? 240. The examiner said the whole amount was done what? Allowed. So the whole 240 was allowed for tax. But should there be any book value, that should be subject to tax assessment. Question? So the examiner only wanted temporary differences. So can you add for me temporary differences? Add the temporary differences. Don't expect something very unique from what we are doing. Yes, please.
You say that there's some different tax, the intangible assets.
They will assess. No, patents. If you have patents, the patents will we are coming up with a certain innovation. So the government in the first years they will allow you in full. But if you continue recognizing that value in the books, when you are allowed, you're not supposed to recognize any amount in the financial statement. That patent right. So if you consider that that one should now be subjected to, it will be assessed for tax purposes actually. Complain baadaye. I want you to be in a position whereby you say, ukianguka, kila mtu ameanguka yafaa. Wewe ukianguka, in case kitu ifanyike wewe umeanguka, kila mtu ameanguka. Country yote. So it means you must pass. Ama? Yes. Juu kwani wao watakuwa wamefanya nini hiyo yenye wewe ufanye hapa? How much is this? 10? 1064.
Yes.
So how many marks? 8. So 8 is 1, 2, 3, 4, 5, 6, 7, 8. Then allow me to calculate the fact tax because hapo mbele wanasema journal Roman 2 journal entry to record what? Changes in the deferred tax liability. So I must get deferred tax. So get for me deferred tax there. So down there you say therefore deferred tax. Na hizo therefore kwa mtenda nataka unaziweka kubwa yenye na measure you know what is happening. Yeah? Deferred tax, unajua zinakuanga za kudanganya examiner unajua. Hata kama answer ni wrong. Therefore, deferred tax is 30% of the 1064. So 1064 by 30, you're supposed to recognize 319.2. So that is the closing. Were we given the opening deferred tax? Where? Oh, where the question started. Mafuta Limited are a deferred tax liability 2018 of how much? 400 million. At the end, it has gone down to 319. So for you to come up with the journals without problems, please let's come up with the deferred tax account. Itatusaidia as a working. So deferred tax account. Deferred tax account. Deferred tax account. Balance brought down. Balance brought down the 400. So we have 400. Then at the end of the year, we have calculated 319.2. So I will comfortably take the decrease. Decrease is an income, tax refund. The decrease from 4 to this, I will comfortably take it to P&L. But because there was revaluation, it was not number, which one? 5. There was revaluation of how much? 200. So that one is part of this one here. So check how much of this was brought by revaluation. Then you say revaluation. Revaluation is 30%. 30% of the 200, giving us 60. So what will go to the P&L is a decrease, which is okay, no problem. So P&L we will take how much? You get 140.8. So we can pass journals. So journal entries. Journal entries. So journal entries, BRCR. So I will pass this one here, this one, and this one here. You can start with any. Let me start with this. I've credited deferred tax, so I'll debit revaluation reserve account, revaluation account with 60. Then you credit, we have credited deferred tax. Deferred tax has been credited with 60. You can give narrations to recognize or to record deferred tax on revaluation. Then we pass this other one. This other one, we have debited deferred tax. So we have debited deferred tax account. We have debited deferred tax account with 140.8. So I'll credit which account? Yeah, sure. With 140.8 to record deferred tax income. That is an income, deferred tax income for the period. Now, in the new syllabus, when you read the new syllabus, there's something they say. That deferred tax, it was not there before, which is not appearing in the questions you have been doing. They said including group aspects. So calculating deferred tax for a group of companies in the consolidated. So they said that, but they brought the question earlier in 2021 September. So can we check that September? This is a new issue for the group companies. September 2021. September 2021. I don't know which question. Question 3. Question 3. September 2021. Question. Used to recall. So question 3. Required. Required. Determine the deferred tax. Deferred tax asset or liability for Huruma Group as at 31st March 2021 in conformity with IS number 12 of income taxes. So, to indicate 2, then God will bring the answers. So, Huruma Group, deferred tax, detention, as at when? 31st March 2021. So, as usual, we'll say here assets and liabilities so that we get temporary first. Right there, carrying amount on the looks. What do you see many single figures? Millions. Temporary the tax base, millions. Then you report temporary differences also in millions. So hiyo ndio unajipanga hivyo, ile kizungu mnasemanga we cross the bridge. So we have to cross your bridge right now. So we read Huruma Limited, a public limited company, as a portfolio of investments, including various subsidiaries, and also undertakes various projects varying from debt factoring to investing in property and commodities. The following information was extracted from the group financial statements relating to the deferred tax provision for 31st March 2021. So 1. Safari imeanza. Huruma Limited acquired a controlling interest in a subsidiary, Sukari Limited, on 1st July 2020. The fair value of the assets and liabilities acquired were considered to be equal to their carrying amounts. Kwa nini wanasema kizunguni kama tumezoea, si ndio? With the exception of freehold property, which had a fair value of 256 million and a tax base of 246 million. The directors of Huruma have no intention of selling their property. Sasa ni nini wanasema vimingi? Si book value ni hiyo 256 and tax base is 248. Why were they taking us a long story? Mpaka mtu anasikia ni kama tunataka kuanza consolidation. So PP, this is 256 and this is 240. A difference of how much? 8. taxable. So this is September 2021. Let's go to number 2. During the year, Huruma Limited sold goods. Huruma Limited sold goods at a price of 48 million to another subsidiary, Wingu Limited, and made a profit of how much? 16 million on the transaction. Hiyo 16 ni nini kwa kizungumzuri? Sio ni UPI? Yes, 16 million on the transaction. 40% of these goods were held in the inventory of Wingu Limited. Yes. So give me inventory. So what is the book value? It's not hard, imagine. It's very simple. What is the book value? %, remained in the inventory. Yeah? Are you getting the book value I'm getting? What is the book value? Yenye tu napata. Okay, I'm going to say my yangu, then people can support. I'm getting 12.8. Yes. Yes, it is 12.8 because they sold 48, and number 1, UPI we have to subtract. So minus the UPI is 16. So you are remaining with the correct value of the inventory to be how much? 32. Then out of the 32, they were only holding 40%, meaning they have sold the rest. So times 40, that is 12.8. You can show how you arrived there. That is 12.8. Taxman is coming. Yeah, that's the story. Taxman will arrive. Taxman comes. When taxman comes, now look at what was the cost. Then was there tax base? If no tax base, cost is the tax base. Can you check for me? Try to work tax base, meaning you gross back to cost. Yes, I got the cost. The cost is 19.2. 19.2. How did you arrive at 19.2? What was going on? The cost was 48 million. The inventory was? Yes, the goods remaining, the remaining goods is 40% of 48. Which comes to? Huh? You go to direct. Okay, that is one way you can take. Is there another way? Yes. Which one? 48 minus 16. 48 minus 16 to get the cost, which is 30 what?
Then there was the 60%. That,
yes. The 60% which?
That was sold in
whichever, the actual. The only fear I have with this 40% of 48, 48 was profit inclusive. Another way, that's
16, but 40% of 16, and you add to 12.
You take 40%, that's 40% of 16. 16. So, but I think the best approach is this one. The cost is 19.6. You add back that unrealized profit. Actually, yes, even what you're saying is yes. You can get the 40% of the unrealized profit, then you add back. Yeah. That's 19.2, yes. So that one comes to 6.4. Lakini hakuna mtu atakuuliza kwa mtihani venye umepata 19.2. There is no problem. Bora unajua tax is the cost. Haya, we proceed. Number 3. Huruma Limited has a portfolio. Kuna portfolio kila mahali. A portfolio of financial assets comprising readily marketable government securities, which are held as current assets for financial trading purposes. These investments are stated at fair value in the statement of financial position, with any gain or loss taken to P&L. These gains or losses are taxed when investments are sold. Currently, the investment have a market value of 412 and accumulated and realized gains are 64. So where are they from? Financial assets investment. They have called them investment. So can you present for me those two? Everything is between 412 and that other one. So play around. What is the book? Oh, come on, what is the book value? The book value, the carrying amount is 412. Yes, book value is 412. 412. What about the tax base? Do we add the gain or we subtract the gain? Do we subtract? Yes, the gain. The gain already is there. So remove that gain to get the real cost. 348. Again, because even they have said, the gains are taxed when what happens? When they are sold. So the 412 includes the gains. Gains are taxed when sold. So you see what dispose your investment down your tax. So that is how much? 64. Next, number 4. Huruma Limited loan asset has a carrying amount of 168. After allowance for credit losses of 32 million based on the 12-month expected credit loss. So I know what to calculate credit loss in banking. Tax relief only available when the specific loan is written off. So right there, loan asset. What is the book value? 160, 168. This is after making what? Allowance of how much? 32 gross back. So to how much? 200. 200. So that is 32. Yes. Next. Number 5. Huruma Limited has unrelieved trading losses of 20 million as at that. Okay. These unused tax losses arose from one-off restructuring exercise carried out during the financial year, and is highly expected that taxable profit will be available in the future. Full stop. Okay. Which is which? Yeah? That is what they are calling unused tax what? Unused tax losses. Unused tax losses. Those things, hakuna book value. The book value is 0. But they are saying, let's read once more. Has unrelieved trading losses of 20 These unused tax losses arose from one-off restructuring exercise carried out during the year, and it is highly expected that taxable profits will be available in future. When they are available, fine. So the unused tax losses, okay, we have tax losses in the books. So no, tax losses, how do we account for them? So they are meant to offset the subsequent taxes in the what? In the future. So currently there is nothing like book value, but the unused tax loss of 20 should reduce. It should reduce any taxable amount. So the taxable amount will be reduced by the unused tax losses. Ama unaambia KRA wa kurefund, eh? Unaambia wa kurefund. They can only refund you by you offsetting the amount. Yes. Yes.
So categorizing those items there as assets and liabilities.
Yes.
So how are we categorizing this?
And these tax losses I'm categorizing as part of assets.
Part of assets.
Yes. It's an asset. Ama. Unused tax loss, see on the asset, which is meant to reduce the tax liability. Yes. So it's an asset. It's an asset, not a liability. It's an asset on our side. That is why I'm reducing. Number 6, Huruma Limited deferred tax account had a nil balance. Assume so there was no deferred tax at the start. Fisher, can you get for me this? So you are likely you can get deferred tax on group. Upate hizo mambo ya unrealized profits, what, but provided you know the approach to deferred tax, you are safe. How much is that? 13.6. But what was the question? The requirement. Determine the deferred tax asset or deferred tax what? Liability. So therefore, deferred tax is going to be an asset or liability. It is positive. So deferred tax liability is equals to 30% of 13.6. That should be for something. $4.08. 4.08 million. Our last question, pilot paper. No? Before we go to that, question 3A. Check question 3A, the one we are doing. Question 3A. Question 3A, they were saying, with reference to the deferred tax, differentiate between permanent differences and temporary differences. I'm not writing about temporary. Temporary is temporary differences is the difference which arises. Temporary arises is the difference between the carrying amount of an asset or liability and its what? Tax base. So tunandika permanent. Permanent means they will never change. So right there I'm saying these are differences which arises. These are differences which arises when an item has been recognized in one profit computation. An item has been recognized. An item has been recognized in one profit computation. In one profit computation, e.g., in accounting profit computation, e.g., in accounting profit computation, in accounting profit computation, but is expected to be ignored. Is expected to be ignored. Is expected to be ignored in the other profit computation. be ignored in the other profit computation, in bracket, taxable profits. Close bracket. In the other profit computation, in bracket, taxable profits. Close the bracket, e.g. depreciation, comma, general allowances are recognized in accounting profits, computation, recognized in accounting profit computation, but are disallowed for tax purposes. Full stop. I want us to finish with the pilot paper, September 2015. September 2015. September 2015. Huko mwisho. September 2015. Which question? Pilot paper, September 2015. November, this is November. I got it. Question number 3. Question 3B. Question 3B. Check question 3B of September 2015. Read that question, go through it. For time, let's read together. It says this, sophistic. That question mark can be. Sophistic Limited, a newly listed company, has provided the following information with regards to computation of its tax expense for the year ended 31st May 2014. So in 2014, their accounting profit was 42,900. They added back depreciation, they added back donations, they added back amortization of software. Are all donations disallowed? For tax purposes? Are allowed?
Yes.
Oh, so someone to share the question for some people online. Joyce, early morning, which class? Evening? Evening. So they added back all that. Then they subtracted the capital what? Allowance. Then the amount they got, 44,800, was charged at a tax rate of 25%, and they got 11,200. So the 11,200 is current tax. So current tax is based on the taxable what? Profit. And what is taxable profit? From even what you can see, taxable profit is the accounting profit, yes? Accounting profit plus disallowables minus allowables. So to get the taxable profit, take all the allowable, you start with accounting profit, you add back the disallowables, then you subtract the allowable deductions. Then what remains is subject to tax. The company has not yet determined tax expense for 2015. So najua hiyo ndio wanataka tutafute, sio? Additional information, 1. Accounting profit for the year 2015 was 55,200. Underline that in case wanatuletea issue, that is where we'll start from. While donations amounted to how much? 600. So underline donations under 600. An extract of non-current asset movement schedule for the year 2015 was as follows. So plant and software. So cost, plant was 32, software was 9. Additions during the year, hakuna. Accumulated depreciation, tax written down value. Tax written down value is the WDV, the written down value, which is the tax base. That's what you need to know. Written down value is the tax base. So tax written down value is the tax base on that date. Plant is depreciated at 20% per annum using the straight line method, while wear and tear allowance on plant is provided at 25% on reducing balance basis. Software development commenced in the year 2011 and was completed in the immediate subsequent year. The company capitalized development cost, which amounted to 9, and amortization commenced in 2012 using the sum of digits method. Using the sum of digits method over the estimated useful life for 5 years. Software development costs are allowed in full for tax purposes in the year in which they are incurred. Donations made by the company were not tax allowable. Donations made by the company were not tax allowable. So that will add back. Corporate tax applicable on the company's earnings for the year 2015 is 30%. And the company is expected to continue generating taxable profits in the foreseeable future. So required. So required, they want us to compute current tax to be charged in the income statement for 2015, deferred tax liability to be reflected in the statement of financial position 2014, deferred tax liability account for 2015. So let's start with current tax. Current tax computation. So right there, sophistically limited. Very sophisticated. Sophistic. Imagine ukiangalia hiyo swali za kufikiria ni serious. It's very easy, hakuna kitu hapo. Sophistic limited current tax computation. Current tax computation for which year? The one for the year ended 31st May 2015. So now, how do we get current tax? This one here, it benefits people who are doing tax, but the examiner was fair enough. They gave us how they computed tax for 2014. So for students who are not doing tax and who are saying they're doing tax, you copy. Unaona sasa sizes what at tax. Unaona hiyo yao ya 2014. Una copy hivyo venye wamefanya, but now in relation to 2015. So that was meant to guide us in 2014. What was the same sisi tulifanya tax kitambo, we forgot. So shillings are in thousands. So I want us to get taxable profit. So let's go with the format for 2014, but in respect to items in 2015. Correct. So accounting profit. What was the accounting profit 2015? Not one. 55. Good. Then unaenda na hiyo yao hivyo. Depreciation. So depreciation, we have to check for 2015. Go to note number 3. Yes. Go to note 3. Plant is depreciated at 20% per annum using the straight line method. While now. Plant is depreciated at 20%. Straight line means you charge on cost throughout the useful life. So you just check the cost of plant at the start, multiply. That is not your problem. So the cost of plant in 2014 was how much? 32. So take 32, multiply by the rate which is 20%. What do you get? 60 which one? 6,400. Correct? Donations. Unafuata hiyo format yao. Imagine alafu ile kwa mtihani. Hiyo ndio iko number 5. Sasa zile bado wamewekelea karatasi hivi, don't touch. Unaona kitu inakaa hiyo kabisa. Unashangaa ni mwalimu alifunza ama tulidiscuss kwa group ama niliota, lakini unaona ni kama hiyo kitu tunaiona. So the donations 2015 not one 600. Are we not moving? We are moving. Amortization. Check where it was mentioned. Okay. Note 4. Let's check note 4. Software development commenced in 2011 and was completed in the subsequent year. The company capitalized. Capitalization means you recognize it as an asset. Capitalized development cost, which amounted to 9, and amortization commenced in 2012. Using which method? The sum of digits method over the estimated useful life of 5 years. So now, okay, we have to. So, the small working notes there for amortization. So amortization using sum of what? Digits. Using sum of digits. Sum of digits. Sum of digits. I think sum of digits, you check the useful life. Useful life is how many years? 5. So you add year 1 plus year 2 plus year 3 plus year 4 plus year 5. That is the sum of digits. Come on, 10 years, you continue adding up to 10. How much? How many? 15. Then you check you are in which year of amortization. When did they start amortization? June 20? Amortization commenced when? 2012, eh?
Yes.
So 2012, here we are in 2015. So first June 2012 to May 2013. That is year 1. 13, 14, 2. We are in year 3.
Yes.
So we are in 3rd year. So for this year, for 2015, it will be 3 over what? 15 times the cost of the assets. The cost of the asset is, it was 9. Yes, so amortization is that one there. How much is that? 18. And hey, listen to this for future purposes. Some of digits is funny. You see, for example, year you will compute amortization. It was which year? It's in year 2. So that was year 2. The book compute with year 2, 2 over that times that, you can't get that answer. There is how it is normally operated, which I'll show you. 2 over 15 times 9. Are you getting whatever they showed us there? They showed how much? They showed 24. But when you calculate 2 over 15 times that, you get 2500, because that is not how it is. Hii imekuwa coincidence, imekuwa 3. It goes this way. Which year do you expect the asset to lose more value? Year, the first year of operation or the last years of operation? First time or last? So the first years of operation. Hata simu, ukinunua simu. The first week, not the first month. Hata day 1, hata unalalanga nayo kwa kitanda ujui ililala wapi, si ndio? Lakini the subsequent periods utanichargia, si ndio? So the rate at which you handle it is very high and loses value. So by nature, assets are assumed to lose much in the first years of operation. So if you are dealing with year 1, you allocate the highest. So year 1 is 5 over 15. Year 2 is 4. So we work out 4 over 15 for year 2. Uone kama utapata hiyo answer yao. 4 over 15 by 9. So near 24. Yes, so you unaenda ukipunguza. So hii imekuwa year 3 na pia ni 3. Imekuwa coincidence. Tunaelewana? Year 4 is going to be 2. Then year 5, 1. That is how you operate some of digits. So amortization, we have gotten the exam that you tell naseme sasa aweke na kusata way that we are in year 2. But walaya swapita na. Alright, so this is a 10. So how much is this? How much is the total there? 64,000. Then you less capital allowances. So capital allowances. Capital allowances mentioned in note number 3. Check note 3. Plant is depreciated at 20 using fine. While where and what? Their allowance on plant is provided at 25% on reducing balance. So this is 25%. For tax purposes, you don't go for the book value. Instead, you go for the tax written down what? Value. So tax written down value 2014. 1st June 2014, you inaenda mpaka 2015. So the opening, you multiply with what value? 18,500. That is the tax written down value, which is in quote the net book value for tax purposes. How much is that? Okay. 46? So taxable profit will be how much? What? 59? But the examiner wanted what? What did they want? The current tax. Therefore, current tax will be the taxable profit times the tax rate, which is what? 30%. So how much is the current tax? 17.25. How many marks? 4. So 1, 2, 3, 4, 5, 6, 7, 8. Sawa, iko sawa. Let's go to Roman 2. Assuming no question. Roman 2 of the question. What do they want? Deferred tax liability to be reflected. We get to deferred tax to find it story yet. So, sophistic, limited, deferred tax, computation, as at 31st May 2014. They want it in 2014. So, hapa kuna jina ya kuharibia liabilities. Liabilities haiko hapa. We only have assets, carrying amounts, tax base, temporary differences. Any moment you hear of deferred tax, thinking begins to elaborate something like this. Kama first tax itakuwa imepotea. Wezi potea. The way I know you people, so you're sitting. Assets are only 2. There are only 2 in this question. There is plant. Software. There are only 2. So we are dealing with 2014, not 15. So in 2014, plant, what was the net book value? Check note 2. Check note 2. Note 2, are you seeing the cost 2014? 32. Yes. Accumulated depreciation 2014, 19, 200. See, the difference is the net book value. So take 32 minus 19, 200. Get the carrying amount as easy as that. The carrying amount is how much? 12,800. Umeelewa? Yes, 12,800. Tax base. Tax base is the written down value 2014 for that asset, which we are not even struggling. 18,500. Temporary difference, that minus that. It is 1058 by latest 1107, latest to the bottom Maliza. So 12 minus that. 50? 2700 deductible. So this is deductible temporary difference. Let's go to software. The carrying amount of the software should be, though I think I will buy, should be the cost of the software minus the accumulated amortization, which they call it accumulated. Accumulated depreciation. 54. But can we confirm? If we take 1/15 for year 1, no, year 1 we're supposed to take 5. Yes, year 1 we take 5/15. If we take 5/15, 5/15 times 9, Yes, times 9. 3,000 plus ile ile wamecharge 2014, ile 24 mlipata. So 2014 they charge 24. Yes. 24. Do you 54? Umeelewa kitu tumefanya? Yes. Yes. So just subtract the 54. So take 9, which is the cost of the software, minus the accumulated amortization, though they have put it under accumulated depreciation. How much? 36. When it comes to tax base, I've been telling you, using my software that was allowed in full. What one is there to clear? It's equal to 0, but let's read this note. Read the last bit of note 4. The very last bit of note 4. Software development costs are allowed in full for tax purposes in the year in which they have done what? Incurred. So the year they were incurred, they were allowed to. So I don't know why these people, they still continue to present it in the books. Taxable temporary differences. Question. So give me the temporary difference Give us the temporary differences. What do you guess? 21, eh?
Yeah.
That is deductible. Therefore, deferred tax what? Asset. Negative will be an asset. Is what rate? 25. In 2014, unakumbuka wakicalculate their current tax, they used 25. The tax rate in their 2014 was 25. Why do you think so? The company was newly listed. When a company is newly listed, they are normally given some tax. Yes, that's years. So I think that's why they were using 25 for that year. So 21, what do you get? 525. Tick. Unasemanga tick mpaka wapi? Ukitoka kwenyu unatembea mguu si na gari. Ukitoka kwenyu unatembea kwenyu si hapa Nairobi, up country. Kila mtu lazima kwenda up country, maybe I'm assuming. Ukitoka kwenyu unataka kwenda kwa kutembelea rafiki yako pale. Mwisho inakuanga nini? What brings the barrier between your place and another place? Atibush. Brian has said the river. Yes, it's always the river. So wanasemanga tick mpaka kwa river. Hapo mwisho kwenye imefika. Lakini huyu anasema kwao the difference ya kwao na wengine ni push. Ndio kwa push anarudi. Let's go to Roman 3. Deferred tax liability account. For which year? 2015. So for me to come up with deferred tax liability 2015, I must determine deferred tax for 2015. So that the one for 2014 will be the brought down. So let's do for 2015. So where I think write this one. Me, I'm just deleting this, then I'm doing for 2015. So I just change this to 2015. Then I delete all this working. So if you have that arrangement, umechoka? Oh, bado. Watu walimoni mwalimu ameniambia mko na class after this. FM. Even he has arrived. Maisha ni ngumu, eh? So the same arrangement, land, we should figure out software. So let's be there because there's a way I want us to do it. Land, what was the net book value 2014? So that we just subtract depreciation. So not do depreciation as time goes by. What was the net book value 2014? The one which we had here. 12,800. Eh? So take that 12,800 because 12,800 was for 2014. Then subtract depreciation in 2015. 2015, what was our depreciation? Is here 60 what? 64. Yeah, so subtract 64. That is better. What? 64. So that is 64. Tax base. Tax base. Tax base is the written down value, WDV. What value did we use in 2014? Yes.
We continue that.
Depreciation is the same every year. So it's the same. It's not on reducing, it's on straight line. So every year 64, 64, 64, 64. So they had already subtracted the accumulated back to 2014.
You see what is confusing me?
Amortization itakuja hapo. Okay, good. So tax base. How much was the tax base 2014? 18,500. So to get the tax base 2015, subtract the capital allowance in 2015. So our capital allowance 2015 is this one here. 46, 25. You keep on reducing, you reduce that. Because that 18.5 is what we charge, the wear and tear, this one here. So if you subtract, what do you get? So this is carrying amount. For your own workings, you can do anything. Examples, 18.5 minus 46.25. You reduce that amount. What do you get? Yeah. What? 13,870. Even 2016, you will just continue reducing the wear and tear. So for tax base, reduce the wear and tear. For carrying amount, reduce what? Depreciation. So the difference comes to 70, 72, negative. Yes. Let's go to software. What was the carrying amount of software? It was 36. So it was 36, but how much is the amortization? So how much was the amortization in this year, 2015? 1,800. This one here. 2018. So you reduce that with the for software, you reduce the amortization, you get the carrying amount. So 36 minus 18 is 18. But this was allowed for tax purposes long time ago. It is their mistake to be recognizing that in the books. So you add this full stop. Give me that figure. 56, 75. Negative. Therefore, deferred tax what? Asset will be 30%. 2015 tax rate now is 30. Sure. Yes. 30% of 5675. What do you get? 1702.5. That was not the question. Question is on deferred tax account. Deferred tax account. So deferred tax, remember this is 2015. So balance brought down is the one from 2014. But 2014, it was deferred tax asset. So deferred tax asset you will bring down this side. So balance brought down assets. It was an asset of how much? 5 what? 525. Then even this one carried down 2015 is also an asset. So it will go this way. It goes this side. Balance carried down is also an asset. If it was a liability, I'll bring it this side. Of 1702.5. The increase goes to P&L. If you are told to come up with journals, hakuna revaluation hapa. Ama ilikuwa? Kuna kitu kama hiyo. Examiner cannot disturb us beyond what? By the way, okay, finish that. That one comes to 11.5. With all those questions we have done, if you go through them and they bring deferred tax, so you will maneuver. Furthermore, si lazima mtu apate 100%. So when you go through those ones, and by the way, you know, I hope there is no one who is here by default. You are here because you qualify to be here. So it means Casneb has recognized you that you are qualified to be here. Kuna wimbo wanaimba. Today being Sunday, you know we can sing that uwezi jaribiwa kuliko wale wanaibanga uwezo wako, si ndio? So this is your capability. You cannot be tested beyond your capability. So hii kitu unawezana nayo. Wana Casneb wamekuelewa wakaona you are capable. So unless ni wewe unacheza na capability. So what you do, but there you reading. Unajua hiyo ndio swali. Umeanza kusoma. You know, there's a friend of mine. I've been telling this story. I think he's also a friend of yours. You know, rafiki yako anaweza kuwa rafiki ya mwingine na mjui rafiki yenu wote. There's a friend of mine. I think I'm not very sure, but I think 2017. Hivi tu nilikuwa nasema, naambia anza kusoma. Ati by nature, I don't read in advance. Anasomanga 1 week to exam. I find he was passing. So ikakuja section 6. Waka trans night. The whole night. Siku ya ilikuwa FR and audit. Audit was the last paper in the afternoon. FR used to be in the morning. Nowadays, I think they changed the FR. I don't know if they have changed it. FR itakuwa afternoon. In the time. Imagine FR in the afternoon. So those days it used to be in the morning. No, afternoon. I think that's the semester they changed. FR was in the afternoon. So after audit, while it trans night, there were a group of friends. That friend of mine was called Francis. So there were a group of friends. Ata wakachanga. At immediately after FR, you know, FR used to be section 6. After FR at 5, tukutane Garden City. Na yeye alikuwa treasurer. Audit ikaisha 12. So Francis alikuwa anafanyia KU main campus. After kumaliza akasema, "You wame translate the whole night wakisoma." Francis akasema sasa juu exam imeisha, aende hapo kwa uwanja relax, arudi tu. Aliamka 5. Alilala hapo kwa uwanja vizuri. Alipata invigilators wanaweka kwa karatasi kwa gari wanaenda. Then sasa watu wameanza kumpigia, "Uko wapi tuende?" Juu yeye ndiye akona pesa ya group. Utaambia nini watu? Utaenda kwa hiyo party? But the good thing alirudia na kapita. Utaenda kwa hiyo party? Na ukiulizwa how was the paper, what will you say? It was fair. So tuanze kusoma mapema. People should start reading early. So have a nice weekend. Those who are meeting tomorrow, let's meet tomorrow. God willing. Thank you. So online logouts.